What if I told you that most people lose money in the stock market, not because the market is risky, because they choose the wrong path? Two people invest the same amount of money, same year, same market. 10 years later, one quietly builds wealth. The other is stressed, confused, and disappointed. They both invested in the stock market. So what went wrong? Was it bad luck? Was it timing? Or was it the choice they made at the very beginning, mutual funds or individual stocks? Today, we are not just comparing two investment options. We are uncovering a hidden story of behavior, history, and human psychology that decides who wins and who loses. And by the end of this video, you may realize that the better investment was never the same for everyone. In the early 1900s, investing in stocks was only for the rich. You needed large money, insider connections, and access to information that normal people simply didn't have. Then, in 1924, something revolutionary happened. A company in the United States introduced the first modern mutual fund. The idea was simple but powerful. What if small investors could pool their money together and invest like the wealthy? Instead of buying one or two stocks and taking huge risk, investors could own small pieces of many companies. This single idea quietly changed the financial system forever. But here's the twist. While mutual funds were created to reduce risk, stocks themselves created legends. People like Warren Buffett, who bought individual companies and held them for decades, became symbols of extreme success.
So the world slowly split into two camps. Those who believed in slow, diversified growth, and those who chased direct ownership and higher control. This division still controls how people invest today. Let's talk about stocks first.
Buying a stock means you own a part of a company. If the company grows, you grow. If it fails, you suffer. Sounds fair? In the 1980s and 1990s, stock markets exploded. Technology companies rose fast. Media stories focused on overnight millionaires. This caused a powerful effect. People started believing that picking the right stock is the fastest way to get rich. Sometimes they were right. But here's the hidden cause and effect chain. Stocks reward knowledge, patience, and emotional control. Most people lack at least one of these. Emotional decisions lead to buying high and selling low. Over time, losses increase not because stocks are bad, but because behavior is poor. Study after study shows the same shocking pattern. The average stock investor earns less than the market average, mainly due to emotional mistakes. So stocks did not fail people. People failed themselves. Now let's look at mutual funds. Mutual funds grew fast after the Great Depression, and again after major market crashes. Why? Because fear changes behavior. When markets crash, people realize something painful. Timing is hard. Prediction is unreliable. Emotions destroy returns. Mutual funds offered a solution. Professional management. Automatic diversification, less need for daily decisions. Cause and effect here is clear. Less decision-making gives fewer emotional mistakes. Diversification gives lower risk of total loss. Long-term holding gives better compounding, but there was a cost. Management fees. Less control. Average returns instead of extraordinary ones. So mutual funds traded potential upside for stability and discipline. Here's where things get uncomfortable. Over the last 30 years, data shows most actively managed mutual funds fail to beat the market. Most individual stock investors fail to beat the market, yet the market itself keeps growing, so who actually wins? The investors who stay invested avoid panic, respect time and compounding. This leads to a shocking realization. The investment tool matters less than the investor's behavior. The same repeating pattern appears again and again. Greed during highs, fear during crashes, regret after mistakes. And this pattern destroys returns in both stocks and mutual funds. Today, things are even more dangerous. Apps make trading easy. Social media promotes hot stocks. Influencers promise fast money. This creates a new cause and effect loop. Easy access gives more trading gives higher mistakes. Higher mistakes gives lower long-term wealth. At the same time, mutual funds and index funds quietly continue growing wealth in the background. No drama, no excitement, just time doing its job. This is why many financial advisors say something surprising. The best investment is the one you can stick with during fear. So, which is better for you? Now we return to the original question. Mutual funds or stocks? The answer is this. It depends on who you are, not what the market does. Stocks may be better if you enjoy learning about businesses. You can control emotions you think long-term. You accept temporary losses calmly. Mutual funds may be better if you prefer simplicity. You want diversification, you don't want daily stress. You trust systems over instincts. The mistake is not choosing one. The mistake is choosing against your own nature. Risk is not just market movement, it is human behavior. The biggest danger is not volatility. It is panic, greed, and impatience. Time matters more than talent. A simple investment held for decades often beats complex strategies with constant changes. Consistency beats excitement. Quiet, boring investing often creates the strongest results. Final warning, an open thought here, is the warning most people ignore. An investment that looks good on paper can fail if it does not match your mindset. The market does not reward intelligence alone. It rewards discipline. So before asking, which investment gives higher returns? Ask instead, which investment helps me stay invested? That answer may change your financial future. If this video helped you think differently about investing, like this video, subscribe for more simple finance explanations, and comment below. Are you more comfortable with mutual funds or individual stocks, and why? Your answer might help someone else avoid a costly mistake. Thanks for watching.